In this video, we're going to talk about Fisker, trading under the ticker symbol FSR. Fisker is an EV startup founded by Henrik Fisker, someone well known within the industry, who worked at both Tesla and BMW. One thing that sets Fisker apart from its competitors is the fact that this is the second time its founder tries to have his own EV manufacturer going. In the first attempt, the company was called Karma Auto, and it was eventually sold to a Chinese conglomerate. This company still exists, by the way, and also aims at the high-end luxury segment. This time, Fisker ensured that it'll have its base covered regarding manufacturing capacity with Apple's supplier Foxconn. Apple, on the other hand, is rumored to be working with Lucid Motor, a rival EV manufacturer. Currently, Fisker's valuation is based on future performance, which will arrive around 2022, assuming that there is no delay in the production. The trading volume of Fisker has recently been 8.6 million shares a day, compared to the average volume of 5.3 million shares. Over the previous 52-week period, its price fluctuated between $9.61 and $31.96. The market cap of Fisker is currently at $4.9 billion, compared to an enterprise value of $3.6 billion. The difference between the market cap and the enterprise value is the premium or discount financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. Some of the examples of impact by leverage is if the company has a lot of debt, then the market may feel uncertain about the company's capacity to pay back its interest and principals, which in turn may negatively impact its profitability and solvency. Another key element to understand is the asset composition of many companies, and it is especially true for growth-type companies. For many of them, one of the most significant assets they own is called goodwill. Goodwill is basically an expectation of the market that the company is able to generate more profit or to have more growth than another company, partially because it has a good management, stronger brand recognition, bigger following online, and so on. In other words, it's not a tangible asset that companies can use. However, it's often the reason why companies are perceived to be trading at a discount because the market cap is lower than the enterprise value, which is the value market gives to its assets once the debts are paid off. In comparison to its historical price fluctuations, the stock is 8% higher than the 1-month low, 23% higher than the 3-month low, and 74% higher than the 52-week low. In terms of the options market, which often gives a hint on the market sentiment on where the stock is likely going to head toward, the implied volatility is 78%, compared to a historical volatility of 53%. The put-call volume ratio is currently at 0.34. The most recent volume of options traded has been 34,000 contracts a day, compared to the 30-day average of 19,000. In terms of open interest, the most recent volume of open interest has been 259,000 contracts, compared to a 30-day average of 280,000 contracts. In terms of its shareholder structure, institutional shareholders hold 28% of its outstanding shares. The biggest shareholders include Vanguard, More Capital Management, and BlackRock. The relevance of the shareholder structure is important to determine whether you should be holding the stock long-term or view it as a short-term volatility play. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Of course, there are a lot of exceptions from what I said above, but usually the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound long-term investment and not just a short-term play. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes, if there are significant short interest in the total volume, it could be a sign suggesting that there is an organized shorting operation going on, like what has been going on with GameStop, Ethereum, AMC, and so on. The current short interest is 25% of the total float, which is considered high, and 53% of total dark pool transactions are short positions as well. Now, let's take a look at the indicators. Financial indicators give us a suggestion of what the price movements are showing, and they can be used as one of the elements to determine what should be our overall approach. The oscillators are showing 1 sell, 9 neutral, and 1 buy. So overall, the oscillators suggest an overall neutral tendency. The moving averages of the past price actions have 9 sell, 1 neutral, and 5 buys. The overall tendency from the perspective of moving averages is to sell. The moving average can be used to determine whether the stock is overbought or oversold compared to its previous price fluctuations, which can be used to see if your trade is sufficiently well timed. Regarding the pivot points, which are levels of support and resistance sprinkled in the price trends, the support levels are $10.60, $13.39, and $15.12. For resistance levels, they are $20.69, $22.41, and $25.20. Looking at Fisker from both a corporate and equity perspective, Fisker is a decent company with a lot of potentials, although just like the rest of the market, it's subject to speculation. With that being said, I would say that it has been relatively less volatile than many of the other EV companies. The company is a stock owned by a lot of institutional traders, but massively by retail traders, expecting for it to go up. But beyond those reasons, I think that another reason why traders really like Fisker is because they seem to be attracted by the company as an EV manufacturer, and more specifically, an EV company that didn't really see its stock grow during the heyday and didn't have nearly as hard of a hard landing as many other companies have been having since the transitionary period from 2020 to early 2021. My opinion on the company is that it's a good company to own if you're building an EV portfolio. The company's founder has previous experience and remembers which mistakes to avoid. And this is very important and not often put in value by the market at large. The company is working towards rolling out models, and more importantly, we know that the probability of seeing actual models delivered is quite high here, because Henrik Fisker used to operate Karma Automobile, and I have seen dealerships and models of Karma cars in the streets. In terms of its price action, the overall trend seems to be trending up, and if that's the case, it is locating near a value region, since it's relatively low in this uptrend. We gotta be careful regarding this assumption, of course, since the macroeconomic trends may not favor that much growth stocks. But considering that the stock has often found support between $10 and $15, I think that it's a risk worth taking as long as you control your exposure. My recommendation is to make sure that your exposure in Fisker is at a maximum between 1 to 3% of your portfolio, and to buy in small batches as we go forward, with around 30% of your allocation in the current price level. Regarding the profit target, I would say that the previous peaks are a good place to set your first ones, and save about 40 to 20% of your total allocation for long-term holdings. Your investment should also take into consideration the market conditions at the time, and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long, and when you should be selling it. First of all, the financial market doesn't reflect the real economy. That much is a fact. If the stock market is doing great, it doesn't mean that the underlying company is necessarily hiring more people, increasing the wages, and rising the living standards of its employees. Sometimes it's even the exact opposite, because the stock market is a big pool where money comes in and out, goes to different places in order to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is been used for non-productive purposes like mergers and acquisitions, paying dividends to shareholders, buying back equity, and so on, the less there is for the productive parts. Another way to put it is that ever since 2008, the Dow Jones Index has increased its value significantly. But people don't necessarily see this growth in the main streets. This is why we should be careful with the assumptions of what rising prices mean for a company. Sometimes it doesn't mean anything, other than the fact that the asset is getting more expensive and that their yields is going down. Additionally, some new phenomena are now palpable, and they are the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullbacks. Bubbles have always been created over and over during the past few centuries, ever since there are financial markets. But nowadays, it's quite interesting to see that the speed at which they are created, attract people or capital, and then go bust is getting faster and faster. So almost immediately after the major collapse of the market prices back in early 2020, the same market decided to create a massive bubble of the electric vehicle sector or anything that is related to it. So almost immediately after the major collapse of the financial market back in 2020, the market then decided to, one, recover any sort of price that fell during the first 3 months of the year, and then attract a massive amount of capital into the EV sector or anything that's related to it. Stock prices across the board, but in the growth stocks in particular, went up to the sky for a moment. And even if it didn't last long, this episode definitely allowed market participants, or many of them, to park in their money in a sector and left with either a lot of profits or at least avoiding incurring large losses because they left their money in blue chips or the sectors that are heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months. Because in the scenarios of a short squeeze, companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then trigger even bigger increase in stock price. But I'm not saying that this is always rational, and I'm not even saying that companies will always have a very convincing narrative or good fundamentals. Sometimes there's none of that. A good example is with GameStop. If you play video games, ask yourself if you would really always buy your games at GameStop, knowing that you would be buying those games online as well, or knowing that at least you have the capacity, the right, to buy those games online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price, for the better or worse. Personally, I think that as long as the volatility is high, it'll create opportunities. The final phenomenon is the anticipation of a recession. Many people are expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because of the debt structure no longer sustainable, or that their business model is just bad. But somehow that system was able to hold its ground, especially in the North American market. This is partially because the capital around the world chooses to come to American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that the capital can provide steady returns without being affected too much by central bank policies and inflations, this phenomenon will intensify over time. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain low because the real economy cannot just improve because the asset prices go up. As far as we're concerned, that means that the patience of market participants over the next couple of years will be a great virtue, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and your risk level under check. Your speculative positions should play a relatively modest part of your overall portfolio, so thanks for watching. If you like my content, please like, comment, and subscribe to my channel.